We noticed at the end of the last episode that the cash balance reflected on BrightLeaf's balance sheet changed from $15,760 at the beginning of 2026 to $159,163 at the end. That's an increase of $143,403, despite only earning $98,320 in profit. And while we could look closely at our balance sheet to determine, at least at a high level, where the additional changes occurred, this one account, cash, is so important that we have an entire report dedicated to explaining it, the statement of cash flows. After all, a for-profit entity's primary objective is to, at least in the long run, provide cash to its owners. And the value of the company will depend on how external audiences evaluate the cash flow potential of the business. So let's look at the cash flow statement of BrightLeaf. And as we walk through it, we'll discuss how it's organized and highlight how it connects to our other statements as we go. To begin, all statements of cash flows are organized into three different sections: operating activities, investing activities, and financing activities, presented in that order. And you can see BrightLeaf is no different. They list operating activities at the top, investing in the middle, and financing at the end. Now, the operating activities are meant to describe cash flows generated from day-to-day operations of the business. In that sense, it's very similar to the income statement, and in fact, if an activity lands on the income statement, it's very likely it will impact the statement of cash flows here in operating activities. Now, US GAAP permits the operating activities to be presented in one of two ways, but the overwhelming majority of businesses, including BrightLeaf, choose what's called the indirect method. So that's what we'll cover here. The other is the direct method, and we do have a series on producing a statement of cash flows that covers that in depth. But for this series, we'll focus on the method you'll most certainly come across in the real world, the indirect method. So when using this method, we begin the operating activities with net income, and then present everything necessary to reconcile our net income from the income statement with actual cash flows arising from operations. To do that, you can see we have to handle a couple things. First, we remove the impacts from the income statement of items that don't affect cash. For BrightLeaf, that's their depreciation expense arising from depreciation of their fixed assets. But you'll see other things here as well. Some common ones would be stock compensation paid to employees, the impact of deferred taxes, or impairment charges. All of these items are recorded as expenses, or in the case of deferred taxes, possibly income, but do not affect the cash position of the company during the period. Then next we have to account for our working capital, the changes in our operating assets and liabilities. For instance, at BrightLeaf, our accounts receivable balance on the balance sheet began at $7,000 and ended the year at $5,000. So if we look at the income statement, we recorded $600,000 in revenue. But we also had a net collection of $2,000 in AR during the year. Imagine those are two single invoices, and we collected the $7,000 on the one outstanding at the beginning of the year, and then have yet to be paid $5,000 on an outstanding invoice at the end of the year. So our cash from revenue activities was really $602,000, made up of the $600,000 we recorded on the income statement and net $2,000 we collected in AR. And it's the same idea for the other working capital items. For instance, with AP and wages payable, if we look at our balance sheet, our balance grew during the year from $15,000 to $18,000, which means we recorded $3,000 more in expense on the income statement than we actually paid out related to these accounts. So once we adjust for non-cash items and changes in our operating assets and liabilities, we can see that while BrightLeaf reported a profit of $98,320 during 2026, the net cash provided by operations was $129,844. And this is primarily due to the fact that depreciation weighed down net income by $27,680, while having no effect on cash. Then the next section is the investing activities. which presents the cash flows from purchasing and selling long-term assets. If we look at BrightLeaf's balance sheet, we can see that their equipment account grew by $7,000 during the year, while their furniture account grew by $1,800. And while it is possible these were acquired without using cash, perhaps by issuing stock to the suppliers or swapping them for another asset, we can confirm on the statement of cash flows that BrightLeaf did indeed pay cash for them. The company used $8,800 of cash to purchase furniture and equipment during the year, equal to the change in the two accounts. And while for BrightLeaf in 2026, this section is relatively small, you can see very large numbers here as well. Recall that BrightLeaf owns the building they operate in, which they purchased for $500,000. And we discussed that only $12,500 of that expense ends up on the income statement each year in the form of depreciation. But on their statement of cash flows for 2025, that entire $500,000 would have been presented here as a cash outflow, which would have been the primary reason that while the owners invested $400,000 and they took out a loan, they ended 2025 and began 2026 with only $15,760 in their bank account. Then finally, the third section is the financing activities. This section captures all the money that flows in and out of the business through either debt or equity. So you can see some items here for BrightLeaf. We've already seen on the statement of owner's equity the $50,000 in additional investment during the year. And we can confirm here that it was indeed a simple infusion of cash into the business. Then we also have the dividends paid to owners. And then one we haven't seen yet, we have the principal repayment on the loan the company has outstanding. Now the interest portion of that loan would have hit this statement of cash flows up here in net income. It's reported as a non-operating expense on the income statement. But the cash outflow for the principal repayment is captured here. And if we look at the balance sheet, sure enough, the long-term debt reported between both the current and non-current portions fell by $2,640 during the year. Then finally, at the bottom of the report, you can see the reconciliation from the beginning to ending cash and equivalents on our balance sheet during 2026. The $143,404 increase in cash is simply the sum of the operating, investing, and financing activities, and it's $1 off the change we saw on the balance sheet just due to rounding to the penny. So after reviewing this statement, we can easily spot why our cash increased by $143,404, while the profit on our income statement was only $98,320. For one, we only purchased $8,800 in new equipment, while the company reported $27,680 in depreciation expense on the income statement. And the other major item is the $25,000 in net cash the company received after considering the new stock issued and dividends paid out. They brought in $50,000 in new owner's equity while paying out only $25,000 in dividends. And that's why this report is so important. It makes it that easy to see how cash flowed through the business. And with that, we've covered all four of the primary financial statements. The income statement told us that BrightLeaf earned a profit during the year. The balance sheet told us what it currently owns and how those assets were funded, whether through liabilities owed to others or equity held by the owners. Then the statement of stockholders' equity detailed how the owner's stake in the business changed during the year. And the statement of cash flows provided the detail on how the company's cash balance changed during the year. And as we've seen throughout, these are not four separate statements. They're all connected to each other and work together to present the financial condition of BrightLeaf. But we're not quite done. We've said a couple times that complete financial reporting under US GAAP includes both the four primary financial statements along with the notes. And the notes are just as important as the other pieces. They provide detail far beyond what we see on the four statements alone. So let's look at those in the next episode.